investing is a loser's game. And so the best way to win at tennis is at investing is by not hitting losers. Now, I believe also that it's a loser's game, not as much as Charlie believes, and not for the same reason. Charlie believes that investing is a loser's game because the market is efficient and securities are priced right. I believe there are inefficiencies. I just think it's hard to consistently take advantage of them, and you have to be an exceptional person to take advantage of them on a consistent basis. And the reason that the pro can go for winners is because he is so well schooled and practiced and steady and talented that he knows that if he does this with his foot and this with his hip and this with his elbow and this with his wrist, that the ball will go where he wants. He doesn't worry about miscues, wind, sun in his eyes, distraction. He's so well schooled. And in fact, in scoring tennis matches, they keep track of something called unforced errors. And the reason they keep track of them is because there are so few. The pro doesn't make a lot of unforced errors. We make unforced errors all the time. And so in order to survive, we have to avoid them. So the point is, if you're going to be an investor, you have to decide, am I good enough to go for winners? Or should I emphasize the avoidance of losers in my approach? And then the fourth input, I say here that the difficulty of getting it right is what makes defensive investing so important. Because it's just, for us, in investing, especially because there's randomness, if we do the right thing with our foot and hip and arm and elbow, we're not going to get a winner every time. And then the fourth origin that I wanted to talk to you about today was my meeting with Mike Milken in November 1978. So in 78, I got a call from my boss at Citibank, and he said, there's some guy in California named Mike Milken, and he deals with something called high-yield bonds. Can you figure out what that means? Because one of our clients had asked for a high-yield bond portfolio, and in that day, nobody knew about it. It was unknown. And so I met with Mike in November of 1978. He came to see me at Citi in New York. He was looking for clients. He was just starting off in the high-yield bond industry, and it was a great meeting. And he explained to me that if you buy AAA bonds, there's only one way to go. AAA bonds are bonds that everybody thinks are great. Their companies are making a lot of money. They have prudent balance sheets. The outlook is good. Everything's perfect. So if everything's perfect, that means it can't get better. And if it can't get better, that means it can only get worse. It doesn't have to get worse. But if there is a change, it's going to be for the worse. And if you've bought a bond on the assumption that it's perfect and it gets worse, then you lose money. So that's important. On the other hand, he said, if you buy single B bonds and they survive, there's only one way for them to go, which is upgrade. Now, that's not exactly true because they can default and go bankrupt. But the ones that survive will go up, will be upgraded, and the surprises are likely to be on the upside. So this was very important. Again, this is about trying to hit winners, avoid losers. And if you're buying bonds that most people don't think much of, it's hard to have a big loser because such low expectations are incorporated. Now, let me digress for a minute because this is really important. How do you make money as an investor? The people who don't know think the way you do it is by buying good assets, a good building, stock in a good company, or something like that. That is not the secret for success. The secret for success in investing is buying things for less than they're worth. So if you buy a high-quality asset, and I say in the book, there's a guy on the radio. I used to, when I lived in L.A., I listened to NPR on the way to work. And there was a guy and I heard him say it. He said, well, if you go into a store and you like the product, buy the stock. This couldn't be more wrong. Because what determines the success of an investor is not what he buys, but what he pays for it. And if you buy a high-quality asset, but you overpay for it, you're in big trouble. And you can buy a very low-quality asset, but if you pay less than it's worth, chances are you're going to make money. So the book says, chapter 3 says, the most important thing is value, figuring out what the value of an asset is. But number 4 says the most important thing is the relationship between price and value. So let's assume that you're able to figure out the value. If you pay more than that, you're in trouble. If you get it for less, the wind is at your back. So it was very, very important then to be in an area where the surprises were likely to be on the upside. And if you buy the bonds of B-rated companies about which there are such low expectations, maybe it's easy for there to be a favorable surprise. Now, how can I prove to you that the expectations were low? The answer is that if you look in the Moody's guide to bonds in those years, what was the definition of a B-rated bond? Quote, fails to possess the characteristics of a desirable investment. In other words, it's a bad investment. Now, I drove here from the airport in my car. And if I take you outside to look at my car and I offer it to you for sale, because I don't need that car anymore. When I'm done here, I'm not coming back. If I say to you, would you like to buy my car? What is the one question you must ask me before saying yes or no? Price. You get an A. You get an A. So, in other words, it's a good buy at a certain price. It's a bad buy at another price. Moody is now saying that B-rated bonds are a bad buy without any reference to price. So, in other words, there's no price at which a company that has some credit risk is worth investing in. And by the way, before I turned to high-yield bonds in '78, I was part of the bank's machinery to buy the bonds of the stocks of America's best companies. And I explained at lunch how if you bought the bonds of Hewlett-Packard, PerkinElmer, Texas Instruments, Merck, Lilly, Xerox, IBM, Kodak, Polaroid, AIG, Coca-Cola, and Procter & Gamble, and if you bought them all in '68 and you held them until '73, you lost 90% of your money. Why? Because they were overpriced. The average stock since the post-war has traded at 16 times its next year's earnings. These were trading at 80 and 90 times. Why? Because they were so good. Everybody says, these are great companies. Nothing can go wrong, so it doesn't matter what price you pay. And if you pay 80 or 90 times, that's fine. So here we are, in my experience, again, experience as a teacher. You invest in the best companies in America, you lose a lot of money. Then you go to the high-yield bond business, you invest in the worst companies in America, you make the most money. So it's an instructive lesson if you have your eyes open and you learn from experience, which I did. But the key words were, and they survive, right? There's a little trap there, because you have to catch those 3 words. If you buy single B bonds that don't survive, then you're in big trouble. So, but it's obviously, it's tautologically true that if a company about which the expectations are low survives, it'll probably, at minimum, it'll pay off at maturity, and maybe in the meantime, it'll be upgraded or taken over if they survive. So what that convinced me when I was starting the high-yield bond business, and this conversation came at a great point in time, is that my analysts should spend all their time trying to weed out the ones that don't survive. Not finding the ones that will have favorable events, but just excluding the ones that have unfavorable events.